This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Tech's big night. The industry was put to the test and passed with flying colors as Alphabet, Amazon, Microsoft, and Intel blew past earnings estimates.
Blockbuster deal. CVS Health is reportedly in talks to buy Aetna in what could be a transformative deal for the healthcare industry.
The fault in our stars, why your highly rated mutual fund may not be all it's cracked up to be. Those stories and more tonight on Nightly Business Report for Thursday, October 26th.
Good evening, everyone, and welcome. Lots to tell you about tonight. A possible major deal in healthcare, a presidential push against opioid addiction, and a report that questions how you probably pick mutual funds. But we begin tonight with major news about profits in techland, and they were good. Expectations were high, and big tech did not disappoint. 4 major companies reported quarterlies that were much stronger than anyone expected. Let's start with Amazon. The story here, simple. Revenue up, profit up, the stock up. The company earned 52 cents a share. Expectations were for 3 pennies. Sales jumped more than 30% to about $43 billion year over year. Investors, well, they're giddy, sending Amazon shares initially higher and through the $1,000 mark. Jackie DeAngelo zeroes in on the biggest surprise in Amazon's report.
One of the key points of interest for Amazon's third quarter earnings was how its web services division did. And the company delivered. That segment bringing in revenue of $4.58 billion, handily topping analyst expectations. Amazon Web Services, or AWS, is Amazon's version of the cloud. It's an emerging space where many companies are competing for share, and Amazon appears to be one of the winners. As business in the division grows, the high bar will be more difficult to top. But for this quarter, it was certainly a standout. For Nightly Business Report, I'm Jackie DeAngelis.
Up next, Google's parent, Alphabet. It has a similar story and one that any company would envy. Alphabet's profit grew more than 30%. Revenue jumped more than 20%. Its stock got an initial lift from upbeat shareholders after the bell. And Josh Lipton explains why.
It wasn't just a beat on earnings and revenue. It was also because Google is showing better profitability. Aaron Kessler of Raymond James says operating income came in at $7.8 billion, and that was better than what he expected. Kessler pointing out that a concern for investors has been declining margins for Google. They've wanted to see better operating leverage for some time. Now, with this report, they got it. For Nightly Business Report, I'm Josh Lipton, San Francisco.
Now to Microsoft. It reported better than expected profit as demand for its fast-growing cloud computing services rose. It also saw its personal computer software business stabilize. Revenue rose double digits, and that sent shares of the Dow component up initially in after-hours trading, as you see there.
One more to tell you about Intel. It, too, was helped by growth in its cloud computing business. The world's largest computer chip maker topped earnings and revenue expectations and raised its full-year revenue and profit forecast. Revenue from its higher-margin data center business was up as well, and that helped the stock in initial late-day trading.
Well, even before all of those results, the busiest day of earnings season helped drive things today on Wall Street. Better than expected results from the likes of Twitter and Ford early. They set the tone. More on those in a little bit. As for the major indexes, the Dow rose 71 points to 23,400, but the Nasdaq lost 7 and the S&P 500 added 3.
Healthcare was all abuzz late today on a report that took most by surprise. CVS Health is reportedly in talks to buy Aetna. As first reported by the Wall Street Journal, the takeout price is said to be about $200 a share, much higher than Aetna's current share price. That would put the deal's price tag at $66 billion in what could be the largest health insurance deal on record. That sent shares of Aetna higher, much higher, in fact. CVS shares finished the day lower, but this stock and other drugstores and pharmacy benefit managers' stocks were pressured by reports that Amazon obtained its pharmacy license in a number of states. Meg Terrell joins us here on set to talk about it, and there is an awful lot to talk about tonight, Meg. Where do we really start with this story?
Well, let's start with this report from the Wall Street Journal that CVS is looking at buying Aetna. This would be just a gigantic deal, $200 a share, and we'll note that Aetna's stock didn't trade up that high, so it implies the market might not relieve this yet. That would be a 25% premium to where the stock was trading before this report came out. And thinking about what this means for CVS, they already are both a pharmacy benefits manager, so managing the drug benefits for employers and insurers, and they're a retail pharmacy, of course. So this would make them yet another thing, giving them more power to potentially offer to employers when they're trying to do services with them. We've seen this kind of bulking up in other companies. United Health, for example, which is the biggest health insurer in the United States, also has a PBM in-house in Optum. So these companies are getting bigger and bigger, trying to get more sort of ability to offer things to their customers.
You know, there has been a lot of subcontracting of various services in healthcare. Yes. The insurer does your major medical, but then somebody else handles your drugs and somebody else may handle mental health. Are we about to see a consolidation or maybe even a situation where not only do insurers merge with the pharmacy benefit managers, but they may merge with medical systems, healthcare companies, hospital companies, healthcare delivery companies, a Kaiser model?
All of that is probably in the air right now, especially because, going to our second story of the night, there is this threat of Amazon coming in and disrupting everything. If a big player like that comes in, the existing players, a lot of analysts are saying, are going to do whatever they can to get more power in the market, and that might mean conglomerations.
Now, Amazon has gotten licenses in a number of states. Do you view that as more of a test as to how successful they could be, and then maybe try and get licenses all across the country, or is there something else to it?
It's not totally clear what these licenses mean. This is reported today by the St. Louis Post-Dispatch. It could just mean it sort of supports existing things that Amazon already does, but a lot of people are very excited about seeing Amazon get into this space, and so interpret it as an initial move to get bigger into perhaps drug distribution. We don't know yet. The company hasn't said, but CNBC.com's Chrissy Farr has been reporting a lot on Amazon's moves here, implying that they probably are looking very closely at this.
Thank you, Meg. As always, great to have you with us. Meg Terrell.
Nice to have you here. All right, the healthcare industry also paying close attention today to the president who declared the opioid crisis a public health emergency. By doing so, the government will waive some regulations and give states more flexibility in how they use federal funds. President Trump stopped short of declaring a national state of emergency, but he said he was going to go after bad actors.
I will be looking at the potential of the federal government bringing major lawsuits against bad actors. What they have and what they're doing to our people is unheard of. We will be bringing some very major lawsuits against people and against companies that are hurting our people, and that will start taking place pretty soon.
Meantime, the Fed chief Janet Yellen recently said the opioid epidemic may be tied to declining labor force participation.
The billionaire founder of Inosys Therapeutics was arrested today in an opioid-related case. John Kapoor was charged with racketeering, conspiracy, and fraud. The scheme alleges that he bribed doctors to prescribe a powerful opioid to patients who didn't need it. As we've reported, Inosys has been in settlement talks with the Justice Department in connection with the probe. Last December, 6 other executives were indicted on federal charges. Shares of Inosys fell today by 22 2/3%.
Still ahead, written in the stars, or is it? A new report says Morningstars familiar mutual fund star ratings aren't as predictive as you may think. To the economy now in the housing market. Pending home sales, which account for homes under contract but not yet sold, sank to the lowest level in 3 years. But it's not for a lack of buyers. Diana Olick explains what's behind the slump in the fall market.
A heavy hurricane season in the South may have kept home buyers there out of the market last month, but in the rest of the nation, home sales are being hit by other headwinds: high prices and little for sale.
The tight inventory conditions that we've been talking about pretty much ad nauseum all year finally came to a head in September. We saw the third consecutive month of year-over-year sales declines. Look, the tightness in inventory, the lack of affordable housing, and the huge increases in prices is really tapping down sales.
An index of pending home sales, which measures signed contracts during the month, sat at the lowest level in nearly 3 years in September. While part of that may have been due to the heavy hurricane season, sales have been lower annually for 5 of the past 6 months, and prices just continue to rise.
The only way out is to build more. And right now we are not nearly keeping up with the demand for home ownership or for the rental part of the market.
Maryland real estate agent Eric Murtaugh specializes in selling newly built homes and says there is definitely high demand.
You know, you have people who want the space, they want the more input on the finishes, and we sell properties when they're under construction like this, and so if a buyer comes along and wants to pick their kitchen, their bathrooms, or do other options like an elevator, we're set up to really help them with that.
The trouble is a lack of labor. Subcontractors are heading south to rebuild after the hurricanes, and that makes building everywhere else more expensive.
That really comes into play when we're bidding out jobs and you only have one contractor available to do the work. It's not a competitive environment, and so they're dictating what the cost of the project will be.
With so little new construction nationwide and the labor shortage only getting worse, this housing market needs more sellers. But we're heading into the slow season for that. Winter usually puts a chill on home sales, but this year they could be downright frozen. For Nightly Business Report, I'm Diana Olick in Washington.
The House of Representatives narrowly cleared a budget blueprint that will allow a tax bill to pass Congress without any Democratic votes. The final tally for the budget vote was a tight 216 to 212, in part because a number of Republicans from states with high state taxes voted against the measure. The current tax outline calls for the elimination of a popular deduction for state and local taxes to help pay for other tax cuts.
The Ways and Means Committee will be putting out the specific plan very shortly, and they're going to work with all of our members to look at and consider and address their concerns. I believe that the Ways and Means Committee will be working with these members in particular to find a solution.
The chairman of the House Ways and Means Committee says he will introduce a bill on November 1st and begin deliberations on the 6th.
So how would a reduction in corporate taxes affect the stock market? Steve Leisman did some digging.
It would make sense that with all the talk and all the apparent momentum towards cutting corporate taxes, that the market would be pricing in at least some possibility of it actually happening. Corporate tax cuts will flow right to the bottom line of companies, especially the high-tax companies. But CNBC looked at 3 different baskets of high-tax stocks. The result, all 3 are substantially underperforming the broader market. S&P Global divided up into 3 different categories. The top 100 taxpayers, they've returned 4.8% year to date. The bottom 100 taxpayers returned 11%. And then you take out those companies that are paying no tax, they could be potentially troubled companies. They're up 24% year to date. Here's a basket of high-tax stocks from Strategas and its performance relative to the S&P 500. If it were 100, it would equal the broader market performance. Instead, it's been underperforming most of the year. Now, it popped last month when the tax outline was announced from the Big Six, but seems to have come off again with the spat between Senator Corker and President Trump. That potentially diminishes the chance of passing the tax cut package. 3 reasons have been offered for this divergence. First, the market may not be appropriately pricing in the chance of a tax cut. Second, it doesn't believe these tax cuts are good for the economy or earnings, since they could accelerate rate hikes. Third, the market just doesn't think the tax cuts will happen. Dan Clifton of Strategas thinks the market is underestimating the chance of passage and thinks there's money on the table for investors. Michael Thompson, president of S&P Global, points out the market is focused on growth stocks, many of which don't pay high taxes, so it hasn't really put a value on the high tax companies. The right answer, the market can sometimes be inefficient, especially when it comes to discounting political outcomes. For Nightly Business Report, I'm Steve Leisman. 4
million users flocked to Twitter, and that's where we begin tonight's market focus. The social media company added 4 million new users, reported its lowest net loss in several quarters, and also topped Wall Street's revenue expectations. Twitter did say it overstated its monthly active user numbers since the end of 2014, but investors turned their focus to the company's upbeat guidance, which was that it may turn its first ever profit next quarter. Shares rose 18% to $20.31. Cost cuts and strong demand in North America helped lift sales above expectations at Ford. The automaker also over-delivered on profits. Ford says while it still has work to do, it's improving its financial health as the industry moves into autonomous technology.
What we are working to do is improve the fitness of the business better as a really strong foundation as we enter a really important transitional period for the whole sector, not only the company, as we take advantage of new emerging technologies such as AVs and EVs and so forth.
Shares were up just about 2% to $12.27.
Celgene slashes its long-term outlook. The biotech said difficult market conditions and some disappointments in its drug pipeline would cause earnings and sales in 2020 to be lower than initially expected. Celgene did beat estimates in its latest quarter, but shares touched their lowest level in 17 years, finishing down 16% at $99.99. Tenet Healthcare may no longer be for sale. Reuters says the hospital operator has scrapped plans to sell itself following the earlier than expected departure of its CEO this month. But according to CNBC, a strategic review is ongoing at the company and no options have been taken off the table. Still, shares down 9% to $12.87. And after the bell, Mattel, ouch, disappointing results, hurt by weak demand and the bankruptcy of Toys R Us. The toy maker said it would suspend its quarterly dividends so it could strengthen its balance sheet and increase financial flexibility. Shares, as you see there, got crushed in after-hours trading. They finished the regular session down just a fraction at $15.37.
Profits came under pressure at UPS amid expanded Saturday delivery and recent natural disasters. But revenue climbed and the company issued an upbeat outlook for the key holiday shipping season. Morgan Brennan has more.
UPS expects to deliver a staggering number of packages this holiday season, 750 million. It would be another record, a nearly 6% increase compared to last year. The delivery giant expects to handle at least 30 million packages, or double average daily volume, on 17 out of the 21 shipping days that will make up peak season. UPS CFO Richard Peretz says it's crucial the company get the right return on all of the investments it's making to keep up.
We keep getting asked to do different, create different solutions for our customers during peak. And as we do that, we're putting new resources in, creating temporary capacity. There are very few businesses in the world that can flex 100% of their average daily business for a 4 to 6 week period.
According to a recent Deloitte survey, for the first time ever, more people will buy things online this holiday season than in stores. Companies like UPS and FedEx have been pouring billions into their networks to expand capacity, a year-round process that will be put to the ultimate test in the month of December. To prepare, UPS is hiring 95,000 workers, opening more facilities, putting 3 new Boeing-made jumbo jets into the air, and ramping up Saturday deliveries. It's also slapping a new holiday surcharge on some packages destined for doorsteps, a move analysts are watching closely, since rising costs have been an issue during previous holiday seasons.
From an investment standpoint, I think the market is really looking to see if UPS can handle the scaling of its network to the degree that they have to scale it every fourth quarter. Every year e-commerce becomes bigger. Every year UPS has to do more to make sure that Christmas gets delivered on time. And I think the market is still trying to make sure that UPS can do that and do that profitably.
And UPS isn't alone. FedEx is hiring 50,000 additional workers to handle its own record volumes. And the U.S. Postal Service has said it too plans for a record 850 million packages between Thanksgiving and New Year's Eve. For Nightly Business Report, I'm Morgan Brennan.
Well, a 5-star rating from the investment research firm Morningstar has always meant a seal of approval for mutual funds. Implicit in it, the idea that the fund would remain a top performer. But an article in the Wall Street Journal today questions that premise and the Morningstar methodology, saying that a 5-star rating isn't what you may think it is. One of the article's authors is with us tonight to discuss her findings. She's Sarah Krause, a reporter with the Wall Street Journal. Sarah, welcome. Good to have you with us.
Thank you for having me.
Now, I want you just to sort of tell us what you found, but as I boil it down, it is that once a fund becomes a five-star fund at Morningstar, not always a five-star fund in the ensuing 1, 3, 5, 10 years. Boil
Correct.
it down to me.
Sure. So we spent about a year going through Morningstar's data, and one of the things that we found, the most striking, was five-star funds did attract the vast majority of investor flows, but very few of them failed to outperform longer term. So, for example, a five-star fund, take any five-star fund, only 12% 5 years later had performed well enough to earn that same top mark. And a lot of investors rely heavily on those stars, some entirely, to make their decisions.
Morningstar, I think, would argue that they're constantly looking at their data and their star system, and they have said they view it as somewhat predictive. Is that correct? What response did you get from them?
Well, I would say that they've said a lot of things about the predictive powers of the stars. They've said that they are not predictive. They've said that higher rated funds are more likely to outperform longer term, that they have moderate predictive powers. So they've said a number of different things on that front.
I want to play a soundbite from an interview I did earlier today with Jeffrey Patak. He is the head of Global Manager Research at Morningstar. It challenges some of the premises of your article. So listen, and I'll get your reaction.
Sure.
We strongly disagree with their conclusions. If you take a look at some of the findings that they themselves reported in an exhibit to the study, what you find is that highly rated funds, five-star funds, are about 7 times more likely to succeed than low-rated funds, one-star funds, over a future 10-year horizon. To me, that doesn't look like failure. That looks like a measure that's tilting the odds of success in investors' favor.
So Jeffrey says he disputes the conclusions, and he cites his data that the five-star funds are 7 times more likely to be better performers down the road than the one-star funds. Is
Correct.
it possible that you both are right?
Yes, and we noted in the article that that was the case, but better is merely average. That the five-star funds that we tracked over the 14 years in our study went on to become 3-star performers. So it's one of the things that I think is important to keep in mind as we talk about this is the way the star ratings are used. Morningstar licenses the ratings to fund firms who then include them in their advertisements. The implicit suggestion is that this five-star fund is going to go on to outperform, and that's what our analysis showed was not the case.
So how is an investor, given what you found out and researched, how is an individual investor to use this data to the best of their advantage?
Yeah, it's a really important question, and the premise on all of this and why it's worth having this conversation is that investing in the markets is difficult. It's fraught with risk. I would say that yes, a rating and some of the metrics that Morningstar provide can be used as a starting point, but what we found throughout our research and in talking to investors was that they rely very heavily on it, and Morningstar knows that they rely heavily on it. And in fact, in our piece, an executive that focuses on behavioral finance at Morningstar stated that they know that investors misuse it, and he even questioned, whether they need to do something about that.
It was really an amazing piece of work, Sarah. Whether you agree with it or not, it was hard work. I recommend your article to everybody. Thanks very much.
You.
Thanks for being with us. Sarah
Thanks
Krause
for having me.
of the Wall Street Journal.
Coming up, the first glimpse of what a towering border wall might look like.
President Trump's border wall may be taking another step forward. Today was the deadline for 6 companies to finish building prototypes. Aditi Roy reports from the border in Otay Mesa, California.
For the last 30 days, construction trucks have been humming, the cranes have soared, and workers have been buzzing around this otherwise desolate, dusty part of Otay Mesa, California. It's 2 miles from the border crossing with Mexico. And the project they've been working on, building 8 versions of the border wall of the future.
We will build a great wall along the southern border.
One that fulfills President Trump's vision he spoke so frequently about on the campaign trail. The 6 construction companies behind these 8 prototypes are W.G. Yates & Sons, Elton North America, Cadell, Texas Sterling, KWR Construction, and Fisher Sand and Gravel Company. They were awarded contracts between $300,000 and $500,000 and were chosen among hundreds of applicants. U.S. Customs and Border Patrol spokesman Carlos Diaz says the rules were pretty simple.
They had to have anti-dig, anti-climb capabilities. They had anti-breach capabilities and other number of capabilities that included being able to see through.
The reason? As of 2 months ago, there were nearly 290,000 Border Patrol apprehensions nationwide so far this year. Last year, there were more than 415,000. We got an up-close look at the current border wall with holes in places it had been breached. Those visible marks now guiding enforcement agents as they get ready to test the prototypes.
We're going to be looking at the type of breaches that we see throughout the southwest border. We're going to be looking at techniques.
The prototypes are between 18 to 30 feet high. Compare that to the existing wall back there. That's between 8 to 10 feet high. Ultimately, it's about making the most secure wall possible.
We're always trying to find ways to defeat and to deter those folks from crossing to this side.
Border Patrol officials say they have no deadline for making a decision. They could choose one of these prototypes or aspects of all 8. The big question that remains is whether or not Congress will foot the heavy price tag, with some estimates put at more than $20 billion. For Nightly Business Report, I'm Aditi Roy, Otay Mesa, California.
And that is Nightly Business Report for tonight. I'm Sue Herrera. Thanks for joining us.
And I'm Tyler Mathisen. Thanks for me as well. Have a great evening, everybody, and we will see you back here tomorrow night.